Welcome to episode 2 of Indomitable Forex Trading. For those who are new here, I'm Arcadius, the founder and owner of Indomitable Solutions. I'm running a series of 10 episodes on Forex trading, and this is the second episode. I believe by the 10th episode, you should be ready to trade successfully. Therefore, for those who have not watched our earlier episode, that is episode 1, proceed and watch that episode, then come and watch this episode. Welcome, and let's dive into today's session. So, what are we covering today? Today, just as in the first episode, we shall be covering 4 critical areas in regard to Forex trading. We shall be covering key terms in Forex trading, that is number 1, agenda for today. We shall be covering currency pairs, agenda number 2. We shall be covering the meaning and application of leverage, pip, and spread as agenda number 3. And lastly, we shall be covering the bullish and bearish market as our final agenda for this episode. Therefore, welcome, and let's dive further into it. To start us off in this episode, I want us to look at the common terms that are used in the Forex trading market. It is very important for you to acquaint yourself with the common terms in this Forex trading market so that it is easy for you to maneuver and make successful trades each and every time you're in the market. So let's dive deep into it. We shall start with currency nicknames. As you can check on our screen, I've shared with you a comprehensive list of all the common currency nicknames in the Forex trading market. The first nickname is single currency. That refers to the euro. We have the loonie, referring to the Canadian dollar. We have the Swissy, referring to the Swiss franc. We have the Aussie, referring to the Australian dollar. We have the Kiwi, referring to the New Zealand dollar. We have the greenback, or otherwise known as the buck, referring to the US dollar. And lastly, we have the sterling or pound sterling, referring to the British pound. You'll meet other nicknames, but I believe this is a comprehensive list of the common ones that are in the market. Therefore, let's dive further. Let us proceed. I want us to check at the nicknames that are used for currency pairs. As you can see on our screen, I have a comprehensive list of all of those nicknames for currency pairs. The first one is the cable. The cable refers to a pair between the Great British Pound and the US dollar. The ninja refers to a pair between the US dollar and the Japanese yen. The fiber refers to a pair between the euro and the US dollar. The channel or channel refers to a pair between the euro and the British pound. The yappy refers to a pair between the euro and the Japanese yen. And lastly, the bunny refers to a pair between the US dollar and the Russian dollar. Let's dive further into it. As an epilogue on agenda number 1, I want us to look at the popular phrases that are found in the Forex trading market. I believe each and every time you interact with the market, you'll be able to meet these phrases. Let's check on the screen. The first phrase, which is common or popular, is going long. What does it mean? It means opening a bullish position, which also means a buying trade. The second common phrase is going short. What does it mean? Opening a bearish position. Also signifies a selling trade. The third common phrase is cutting short. What does cutting short mean? Cutting short means to close a losing position early. The fourth common phrase is plunging. Plunging means a price that is sinking or falling from its prevailing value. The fifth common phrase is currency rallying. What does currency rallying mean? Currency rallying means a price that recovers after a period of its decline. Lastly, we have position trading. What does position trading mean? Position trading means trading with huge stop losses for several months or even years. To that point, we've closed down first agenda. Let's proceed to agenda number 2 by diving further into it. So let's dive further into it. Welcome to agenda number 2 on our today's episode, and that is on currency pairs. This happens to be the cornerstone of Forex trading. Unless currency pairs are involved, there is no Forex trading that has been executed. Therefore, be very keen as we explain into this agenda. Forex trading involves trading between two currencies. Each and every time you talk of Forex trading, you are talking of trading between two currencies. Therefore, when one currency is bought, you are simultaneously selling the other currency in that pair. At the same time, when one currency is sold, you are simultaneously buying the other currency in that pair. At this juncture, allow me to tell you what constitutes a pair of currencies. A pair of currencies has got two mega segments. The first segment is what you call the base currency or controlling currency. It always comes first in that pair. The second segment is what you call the quote currency. It always comes second in a pair of currencies. How or why are they used in trading is because when you are executing any trade in the Forex market, you are simply trading based on the values of those currencies. Therefore, you compare the values of the base currency and the quote currency in order to execute any trade. For you to buy, for you to sell, you must be able to compare what are the values of my base currency vis-a-vis the quote currency, and that will inform whether to buy or sell in the Forex trading market. As I've already said, the first currency is always the controlling currency. That means when you are buying or selling, you are buying the best currency, which is the first currency, at the expense or at a trade-off with the second currency, which is the quote currency. At the same time, when you are selling the first currency or the best currency at a trade-off with the second currency, which is the quote currency. For example, in a Euro USD pair, you are deciding to buy or sell the first currency, which is the euro in our case, at the expense of the second currency, which is the US dollar. Hope that sinks, because it will demystify or help us understand most of the subsequent information I'll be sharing with us further into this episode. Let's proceed deep into this agenda. In diving further into it, I want us to look at the types of currency pairs. Globally, we have 3 types of currency pairs. We have the major currency pairs, the cross currency pairs, and the exotic currency pairs. Let's start by looking at the major currency pairs. These are mostly traded by both beginners like you and even professionals in the Forex trading market. They're the most popular because of the following reason. Number one, they're the most liquid compared to the crosses and even the exotics. Secondly, they have got narrow spreads. You'll understand what that means later. And thirdly, they have got wide price movements. That makes them the most popular category of pairs. Therefore, compared to smaller currencies or even the crosses and the exotics, they are the most stable in the Forex trading market. Therefore, countries behind the major currency pairs have solid and predictable economic environments that allow their systems to operate uninterrupted. For that to exist, therefore, we must have stable economic and political institutions in those countries. Therefore, that makes the major currencies the most favorable for trading in the Forex trading market. On the far right of the screen, I've given you a list of all the major currency pairs. Please go through the list, and in case you've got a question, tap on the comment section, drop your question, and I'll respond to it instantly. Let's proceed to the crosses or the cross pairs. So, what are crosses? Get this very clearly. Crosses are currency pairs without the USD. Any currency pair without the USD involved, meaning the base currency and the quote currencies are not USD. Those are cross pairs. Cross pairs can be profitable just as the majors, meaning you can also trade them in the Forex trading market. And these are very important because at times having all the trades or many trades that involve the USD makes those trades risky. And deep into this episode, you'll understand why such trades become risky. But just understand that having multiple trades that involve the USD, that is the US dollar, makes those trades risky. Therefore, it is important to have the crosses to mitigate on the risks that are in the Forex trading market. And if you check right again on the far right of your screen, you'll see a series of the popular crosses in the Forex trading market. Also, go through the list. There are so many other crosses. Any currency pair that does not involve the USD is a cross pair. Therefore, in addition to that list, take your time and come up with your own list of 4 other cross pairs in the Forex trading market. And finally, let's look at the exotic pairs. These are not the most common, or they're not so common in the Forex trading market. However, they are traded less because they are not common, but secondly, they are the most expensive trades you can have in the Forex trading market. Meaning, what happens for the majors does not happen for them. Remember, when a currency is not so liquid, it does not have narrow spreads and it does not have wide price movements, that currency does not come with high profitability. However, for currencies that have got low liquidity and they have got wider spreads and price movements, those currencies are associated with high profitability. As we dive deep into this episode, you'll understand how to use the exotics also in the Forex trading market. To that juncture, I've shared with you 3 currency pairs that are in the Forex trading market. Let's say them together. We have the majors, the crosses, and finally, the exotics in the Forex trading market. Let's proceed with this episode. I'm sure you're enjoying it. Wow, we're already on agenda number 3. Remember, we've already covered two agendas, that is on terms used in the Forex trading market and on currency pairs. So welcome on agenda number 3 for this episode, and that is on meaning of leverage, PIP, and spread in the Forex trading market. Let's start with the first term, leverage. This is a term that will meet more than 1 trillion times as a beginner in the Forex trading market. You have to understand what is leverage, why is it important, and why will you meet it 1 trillion times in the Forex trading market. But I'm here to help you understand that. Therefore, leverage allows you as a trader to borrow money from a broker, who in this case I'll call a third party, or a brokerage firm, in order to place bigger trades. For instance, I might be having $1,000 in my account, but I want to place a trade worth $100,000. That gives me a deficit of $99,000. Therefore, what I do is to borrow the extra $99,000 from a broker or a brokerage firm and execute my trade at $100,000. Is that clear? You have $1,000 in your account, but you want to execute a trade worth $100,000. That leaves you with a deficit. Therefore, you borrow money from a third party through a process we call leveraging. And I'll understand, or I'll teach you how that is done in the Forex trading market. Therefore, what leveraging does, it allows you to place trades that requires more money than what you actually have on your trading account. Why is it important? It's important because small trades give small profits. Just the same way, small trees do not compete with big trees. Also, that happens in the Forex market. You need more money to get more profits. Therefore, by having $1,000 and placing a trade, and someone else having $100,000, and they place a trade, they are guaranteed more profits or more profitability than you, who placed with little money. Therefore, it is important to always leverage in order to make or be guaranteed of higher returns or profits from the Forex trading market. Therefore, leveraging increases your potential for profits, number 1, but at the same time, it also increases your potential for losses, number 2. But I believe by diving deep into these episodes, we shall understand the most appropriate way to leverage in order to mitigate the risks or the losses, but at the same time, maximize or amplify the profits in the Forex trading market. Are we clear? If you've got any question, feel free to tap on the comment section, place your question, and I'll still respond to it with humility, because you are here and I'm here to serve you. You are still there and waiting to dive further into it. So let's do it by looking at the PIP and the spread in Forex trading market. So what is a PIP? A PIP is the smallest currency pair change in the Forex trading market. Get that clearly. A PIP is the smallest currency pair change in the Forex trading market. Mostly it is represented by either the 4th or the 5th decimal place. If we check on the illustration on the far right, we have two illustrations. The first illustration is between the euro and USD, and the second illustration is between the USD and the Japanese yen. On the euro USD pair, 1 pip is represented by 1, which is found in the 4th decimal place. In the second illustration, we have also 1, which is also showing clearly that is the smallest change that can occur when there is a change between the USD and the Japanese yen in the Forex trading market. Let's move further and look at the spread. What is meant by a spread? I want us to get the clear difference between a pip and a spread. What is meant by a spread? A spread is basically the difference between the buying and the selling price in the Forex trading market. The selling price is the bid price. The buying price is the asking price. Always get that. The selling price is the bid price, and the asking price is the buying price in the Forex trading market. So when somebody talks of a bid and an ask, I think that is now clear to you. Therefore, a spread is the difference between these prices, the difference between the bid price and the ask price, the difference between the selling price and the buying price in the Forex trading market. Spreads are measured in form of pips, and it represents 0.0001 for most pairs. I don't mean all, but most pairs that I've already mentioned to you in our previous episodes, in our previous agendas in this episode. Example that has been shared there, we have the Euro USD pair. And the spread in that case will be the difference between the buying price and the selling price in the Euro USD pair, which in this case is 0.0002, which represents 2 pips. On the far left, there is also a clear illustration on how we calculate the spread. And as you can see, the bidding price or the selling price is 1.13281, and the asking price or the buying price is 1.13287. So what is the spread, or what is the difference? The difference is 0.00006, and that represents the spread in that trade. I think it's now very clear to you what a pip and a spread means in the Forex trading market. In case you have got any question, feel free to tap and comment, and I'll respond to you instantly because I'm here to serve you. Let's proceed. We are already on agenda number 4. And I believe you are still there because this is the most exciting lesson on Forex trading. I want us to look at the bullish and the bearish markets in Forex trading. What does the bullish market mean? And what does the bearish market mean in the Forex trading market? A bullish market is what involves the following, or involves the following traders. If you believe a currency will go up, you buy that currency. That means you open a long position, a buying position. This action is called a bullish action, and that is what exists in the bullish market, is whereby you believe a currency will appreciate or go up. Therefore, you end up buying that currency and holding a long position. We call it the bullish market or bullish traders. On the other hand, we have the bearish market. This whereby you believe a currency will go down, you therefore sell that currency and you open a short position or a selling position. This action is what you call the bearish action, or what happens in the bearish market or among bearish traders. Therefore, if you believe a currency will depreciate and you sell that currency, that means you're holding a short position. And what you've done or what you've executed in that Forex trading market is what you call bearish, or you are simply a bearish trader. I believe that is clear. I've given you a clear pictorial to signify what it means for a bullish, signified by the green arrow, and also the bearish market, signified by the red arrow. One is appreciating, the other one is depreciating. That is simply what it means to either hold a bearish or a bullish market position in the Forex trading market. In case you have got further questions, still feel free to comment and I'll respond to them here and there. So let's close down the session. I believe we have had the most exciting session that has covered 4 agendas. And I believe throughout each of those agendas, you've been able to learn and extend or expand the knowledge you gained in episode 1. I'll be sharing with you episode number 3 to further develop that knowledge that you've already gained in this episode. Therefore, let me take this humble opportunity to thank you, my humble listener, for taking your time to listen to this episode, comment, but at the same time, be my listening ear. And not only listening ear, but also being there to pass that information to the next person who wants to get into the Forex market. For beginners and even professionals, I'm challenging you. This is the right market to get into. It is always right to get into the market right and when the time is appropriate. I believe the time is now and the time is appropriate for you to get into the Forex market. For the traders or for those who are already in the market, this is my thumbs up to you. Continue trading because this is the future of money. This is the future of doing business. And I'm certain you are making profits and enormous profits. Therefore, for you to reach me, as I'd explained in the first episode or in episode number 1, you are free. Feel free to call me on 0721 290 925. But because of my other busy schedules, I prefer a DM. Say hi and state your case and I'll respond to it instantly. On the other hand, you can also send me an email on indomitablewriters.com. It has been the Indomitable Tech series running the Indomitable Forex training. And until next time, adios.